Welcome. Welcome to this episode of the Simply Financial Podcast. This is your host, Christopher Calandra, and I want to increase your financial IQ with today's discussion. I think you'll find this statistic surprising. Did you know that the United States has seen a decline in the number of publicly traded companies? So in the late 1990s, it appears that the number of publicly traded companies peaked. It was at over 8,000, maybe as high as 9,000. So let's just call it roughly between 8 and 9,000. Today, estimates range from 3,700 up into the low 4,000s. Let's just, for argument's sake, call it 4,000. And let's say peak was 8,000. It's roughly a 50% drop over the last 25 to 30 years. And this is surprising on its face. It's also surprising, it seems to me, because this decline occurred during a period when Americans have lots of their wealth, liquid wealth, in the stock market. This was a period where Americans allocated more of their wealth to the stock market, not less. Think of 401ks, IRAs, brokerage accounts, college funds, and the like. There are lots of reasons for this, as you might expect. Some of the key ones, it seems to me, though, is an increase in regulatory and compliance costs. This is very expensive proposition for companies to be public. It requires lots of money, lots of time, and officers that sign these documents are personally liable. So there's greater risks to them personally than there was in previous generations. There's also been a massive amount of mergers and acquisitions, and that has restricted the supply of companies. And so that's the second thing after the increase in regulatory and compliance costs. You also, over the last bunch of years, have seen the emergence of multi-trillion-dollar companies. So the companies that are public, at least at the high end of the market, are much larger, massively larger than they used to be, where a company of Google, let's say, as an example, this is just a for instance, they have some properties within there that could easily be 4, 5, 6 standalone companies in previous generations that are all cobbled together under one massive company. And this phenomena has given rise to private equity, venture capital. They have grown tremendously over this period. And what they have done is provided access to private companies such that they can have access to capital and stay private longer, maybe even forever. Now, private equity, venture capital, alternative investments broadly have been around for a very long time, but they have become much larger, much more prominent, and have helped keep companies from going public by offering an alternative that in many instances is very attractive and in many instances was not something that was available 30, 40, 50 years ago and longer. So I believe that this is a problem. It's a problem because everyday Americans have limited access to private equity, venture capital, and alternative investments. These opportunities are just not widely available to mainstream Americans. And part of this is the regulatory structure we work under. There's something called accredited investor rules. You may not be familiar with it, but certain investment vehicles, commonly private equity, venture capital, hedge funds, and other alternative investment platforms, you have to be an accredited investor to participate. And an accredited investor has two tests. You could have a net worth of $1 million or greater, excluding your home. If you have $1 million of net worth excluding your home, you're an accredited investor and can invest in these programs. Or if you don't meet the $1 million net worth threshold and you have $200,000 of income as a single person or $300,000 as a joint person, that would make you an accredited investor too. And if you think about these numbers, that excludes an awful large portion of the American population do not have access to these investment vehicles, even though they've been growing in popularity and market share of available investment opportunities in the United States. So my observation is, my message to you is, Americans are relying on the stock market to a great degree. This comes at a time when we have reducing supply, less publicly traded companies than we used to. I don't think that trend is likely to change anytime soon in a radical way. We also have an increasing supply of investment opportunities in private equity, venture capital, hedge funds, and other alternative investment vehicles. That leads me to the conclusion that things will have to change. Regulations are likely to change over time, and access to these other investments somehow has to be increased. The accredited investor rules, I think, need to be updated. I don't have a great solution for any of this. I am simply identifying something that's worthy of your attention, especially if you're a person that has lots of your wealth in the stock market. I am a believer in that. I also, though, do recognize that this comes at a time when we have a reduced supply of publicly traded companies, and that's not going to change anytime soon unless there are changes in the United States, the regulatory structure especially. So I think because of that, we will see change. So that's my message for today. I hope you found this information to be valuable, hopefully interesting too. So thanks for listening today. I'll be back with you on the next episode of the Simply Financial podcast very soon. In the meantime, please subscribe to the show if you haven't done so already, and recommend it to a friend. That is always appreciated. Thanks again. Have a great day.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.